Okay, so as you can see, the title of chapter 2 is Analyzing Transactions, which, you know we've already been doing that, right? In chapter 1, we started analyzing transactions. So some of this is a bit of a review and a carry through from chapter 1, where we're still looking at transactions. You know, if we invest money into the business, we're increasing cash and increasing common stock. Now the difference is we're going to look at the official or correct way to actually keep those records for accounting systems. So what we're doing in chapter 2 is we're expanding on what we learned on what accounts are and, you know, increasing and decreasing. And instead of saying increase or decrease, we're going to use the terms debit and credit. So it's just putting it into a new system. It's called double entry accounting. The whole purpose is to keep that accounting equation, assets equal liabilities plus equity, in balance. So we're going to learn the proper way to analyze transactions officially. We're going to learn how to journalize those, which is keeping proper records, and we'll post to what we call ledgers. And then we'll do what's called a trial balance at the end, just to make sure that debits equal credits, which we'll get into, and that'll make sense in a little bit. And then in this chapter as well, we'll be doing statements again. It'll be actually a little bit easier because you'll have balances in all your accounts, so you don't have to like use that big long transaction list like we did in chapter 1. So again, chapter 2 is kind of a meaty, really important chapter because debits and credits are like basically the foundation of accounting. So we are going to learn some really important stuff. And again, some of this we already kind of talked about. They don't talk about it officially until chapter 2, but I went ahead and started calling like cash and accounts receivable, revenue, all of that an account, because to me, I don't know how else to refer to it. You know, it's like it's a cash account. So again, you know, we're going to show increases or decreases in our accounting equation and each element separate. So again, an account is just like cash, accounts receivable, fees earned, dividends, all of those are accounts that we'll be using. Okay. So again, you know, we kind of covered this last chapter too, but we're going to add to our list of accounts as we go through each chapter. So we know assets are resources that we own that help us earn revenues, right? So again, we kind of covered these, and as we go through these, you know, feel free on the sheet that I gave you to write down some common assets. It might help you, you know, in your notes and everything, because you'll be allowed to use this on your next exam too. So, hint, right? And it's out on Canvas if you lose it, because I know, you know, if you're like me and you're not good at keeping hold of actual physical paper, it's out on Canvas. So I'm really bad about not necessarily losing, but misplacing, or my daughter like draws on it and throws it away, you know, that sort of thing. So, anyway, assets, we include cash, of course, supplies. We won't really deal with intangible assets in this class, so you don't really need to write that one down. Accounts receivable, which we've dealt with all three of those in last chapter. Prepaid expenses, which supplies is one prepaid expense, but another one would be like prepaid insurance or prepaid rent. And then buildings and equipment. Okay. So those are all examples of assets that we own that help us earn revenues. Okay. And again, most of those we've used before. The only new ones are getting into like those prepaid expenses, like prepaid insurance and prepaid rent are the ones we'll use. Okay. Liabilities, we know those are debts that we owe. And again, the biggest liability we use in this class is accounts payable. Okay, accounts payable. So really, as far as writing down liabilities, I would write down accounts payable. Notes payable and wages payable we won't use right now, so I wouldn't worry too much about those. They're just giving you examples. But we are going to introduce and talk about what we call unearned revenues. So as you can see, it's the only liability that doesn't have the word payable on the end. So it's a little different. So unearned revenue is exactly what it is. It's revenue that we haven't earned yet. So what that means to us is that's when basically customers prepay for services. Okay, so unearned revenue is like, say you buy movie tickets, right? Nowadays, you probably buy them through an app or through your computer. Like we are little AMC members or A-list members or whatnot. So like, you know, I might buy my tickets a week before. Like when we went to Star Wars, I think it was like 3 months before, right? You had to reserve those tickets in the IMAX or no, it was whatever it was, Dolby. So I'm actually paying for my tickets like 3 months before I go, or maybe the day before, or sometimes 20 minutes before, depending on the day, right? So I'm prepaying them, and then they're going to provide the service at a later date. So if they're the AMC, for example, if AMC is selling tickets in advance, that's an unearned revenue, okay? So a customer is giving them cash up front and providing the service at a later date. So this is really common in entertainment. You think about if you go to a concert, you usually don't buy tickets the day of, right, or at the door. They sell out, a lot depending on who it is. So you usually buy them up front, or like athletic events, anything like that. Another place that's really common would just be in like contract or construction. You know, a lot of times you have to pay up front before, you know, even if it's just like a down payment or a deposit before they'll come, you know, re-roof your house or something. So unearned revenues, just make note those are a liability. And instead of owing somebody money, we owe them a service, okay? So with unearned revenue, the customer has paid us upfront in cash usually. Okay, so unearned revenue, customers given us cash up front and we owe them a service. So that's kind of a new account that we'll be working in this chapter. So liabilities, the two you'll want to know, accounts payable and unearned revenues. And then we get into our equity accounts, which again, we've already learned about all of these. We have those that increase and those that decrease equity. Let's see. So we have revenues. Do revenues increase or decrease equity? Increase. Very good. So we know revenues increase our equity. Okay. And they're just giving you a few examples. The biggest one we use in this class is fees earned right now, in this chapter, fees earned. But you might also see like rent revenue. So yeah, I'd write those down under revenues. So fees earned, rent revenue, those are important. Again, when it has the word revenue in it, it makes it easy, right? But when it's like fees earned or fares earned or commissions earned, it's a little trickier. So those are our revenue accounts. Expenses, well, again, the good thing about expenses is they all have the word expense in them. So if you see the word expense and it's not like prepaid, then it's an expense account. So do expenses increase or decrease equity?
Decrease.
Decrease. Very good. So these are some common ones. Again, we can have more than this, but wages expense, rent expense, utilities expense, supplies expense, miscellaneous expense. We can have advertising expense, any of those. Automobile expense. Expenses are pretty easy to recognize, though. Again, in this chapter and the next chapter, we're still dealing with supplies expense, which is that tricky one, remember, because supplies is an asset. So when we first purchase supplies, we recognize them as an asset, and then as they're used up, we expense them out. Oh wait, I kind of skipped. Common stock is also, and it's on your sheet there, so you don't have to write it anywhere. Common stock is also an equity account. It's the only account, you know, it doesn't have any sub-accounts or anything. So common stock is an equity account. Does common stock increase or decrease equity?
Increase.
Increase. Okay. So we know common stock is when people buy shares of ownership of a company. And then dividends. Dividends, again, is its own category. It's another equity account. Does it increase or decrease equity?
Decrease.
Decrease. Very good.
Dividends, you said decrease?
Uh-huh.
Yes.
Yeah, decreases equity. So yeah, those are our main accounts. We'll talk more about retained earnings really in next chapter, but if you remember, retained earnings was really like net income minus dividends. So that was on that retained earnings statement that I know was a little bit of a struggle on the test. But that's okay, we're just starting and learning it, so don't worry. This testing, how much do you really know about the statements? Not very much, but that's okay. By the end of this chapter, you'll know them. Okay, so again, that all is kind of a review. We learned a couple of new accounts, but really learning assets, liabilities, and equity accounts, we already kind of knew most of that. So from this point forward, we're getting into the new stuff in the chapter, and we're looking at how do we classify and how do we record all of our transactions, correctly. So the first thing to talk about is chart of accounts. So a chart of accounts is just a listing of all the accounts that we use in a business. Okay, and we're going to refer to a group of accounts as what we call a ledger. And we'll get into that a little bit more later. But a list of accounts is your chart of accounts. So every company has a chart of accounts, and they're listed in the order of the accounting equation. So we list like all of our assets first, and then all of our liabilities, and then it lists equity accounts. Okay, and then it's like common stock, retained earnings. So kind of the same order in your balance sheet. Assets, liabilities, common stock, equity, then revenues, then expenses. Okay. And we'll be looking at this all chapter. So our chart of accounts lists every account that we use in the business. And that's important because when we're learning how to record transactions, we want to use the proper account title. So that's an important thing to remember. When we're journalizing, which we'll get into later in the chapter, we want to say fees earned, the account that's listed on the chart of accounts. We don't want to just say revenue. Okay. So chart of accounts lists all the accounts. Again, in our class, in this chapter, our chart of accounts won't be super long. It's usually one page. In a real business, depending on how large the business is, they could have hundreds, even thousands of accounts because of what they do. So, but we're not going to go to that scale. We're going to keep it small. Pretty much the accounts we just talked about. So again, they're listed in account order, balance sheet accounts first, and then income statement accounts. And they're all assigned numbers. So this is the one we're using for our sample company Net Solutions. So notice they list assets first. So here's all of our assets: cash, accounts receivable, supplies, prepaid insurance, land, and office equipment. How they're usually listed is we list what we call current assets first, and that's cash through prepaid insurance. Current assets are assets that we think we'll use in the current year. And then like land, equipment, buildings, all that kind of stuff are what we call like long-term assets. So we keep for more than 1 year. So just kind of how you know how they're listed. Notice they're numbered. Notice there's some gaps in numbering. This is just they all start with the number 1 though. Assets all start with ones. They could be 1,001. It doesn't really matter how we number them. That's just how the order goes. So all asset accounts in all businesses will be listed with the number 1. Just so we know, it's kind of a good, easy way to know and say, oh, that's an asset because it starts with the 1. Other than that, I don't think there's any rhyme or reason. The gaps are in case we need to add accounts in there later. Because that happens a lot in businesses. We're like, oh, now that we have this equipment, we need to add a new equipment account or something. And then liabilities, we just have accounts payable and unearned rent. Those all start with the number 2. And then we have our equity accounts: common stock, retained earnings, and dividends. Those are the 3 equity accounts we'll be going with. And then number 4, we have our revenues, which is just fees earned. And then 5, we have expenses: wages, supplies, rent, utilities, and miscellaneous. So for this company, this is the full list of accounts that they're going to use. So when we're analyzing transactions, these are the accounts that we must use. Okay, So that all leads us up to what we call the double entry accounting system. Okay. So again, when we're looking at transactions, and we already started kind of working on this last chapter, every transaction affected our accounting equation, right? It increased or decreased assets, liabilities, equity. And after every transaction, our accounting equation stayed in balance, right? Now we're just building further on that. So it's based on the accounting equation. Every transaction is going to be recorded in at least 2 accounts. Again, that was the same as last chapter. If cash increased, you had to show how cash increased, right? You couldn't just say cash went up. So same principles here. But now we're going to start talking about debits and credits. So every time we do a transaction, when we analyze and record each transaction, we're going to have at least 1 debit and at least 1 credit. Total debits will equal total credits, each transaction. Those debits and credits keep that accounting equation in balance. So the whole point of doing debits and credits is keeping our accounting equation in balance. So that's when this fun sheet comes into play. Okay, we're going to learn what we call the rules of debits and credits. So this one's just the basic accounting equation. The one you have in front of you that I gave you is the expanded one. So the rules of debits and credits, the big thing to always remember, this is probably the biggest thing when we're talking about debits and credits. Debit always means left and credit always means right. Okay. So they're doing what's called T accounts, which come here in a minute in the PowerPoint. But for every account, we have what's called a T account where we'll have the account name up here. Debit is always on the left side and credit is always on the right. Okay. So if you've worked in banking or you deal with your own debit or credit card and you think you have some idea of what debit and credit means, you might have to like wipe the slate clean. Debit means left, credit means right in account. Whether that's an increase or a decrease for account depends on the account. Okay. So for example, assets always increase on the left or the debit side. They decrease on the right or credit side. And when we're looking at this basic accounting equation, how I always think about it is assets are on the left-hand side of the equation. They increase on the left-hand side. Okay. Then we have over here liabilities and equity. Liabilities decreases on the left or debit side and increases on the right or the credit side. Same for equity. Stockholders' equity overall increases on the right or the credit and decreases on the left or the debit. Okay. As far as our income statement accounts, revenues, and expenses, well, I have those on here for you on your sheet. I organized them how it made sense to me. Hopefully it makes sense to you too. So equity accounts are increased on the right, the credit side. So I pictured 2 accounts that increased equity on the right-hand side there. So for equity, revenues increase equity overall. We learned that last chapter. So they also increase on the right-hand side. Okay. Revenues decrease equity. So I listed them on the left-hand side over here. So they actually increase on the debit side. So when we log an expense, we debit it, and it's decreasing equity overall. Okay. And then dividends also decreases equity. So we're going to show that with an increase on the left or debit side. Okay. And common stock, I think I must have missed it. Common stock increases on the credit side because it increases equity overall. Okay. I'm going to write the expanded accounting equation up here too, just for reference as we go through the chapter. Do the examples. So assets all increase on the left or debit side and decrease on the right or credit. Liabilities are on the right-hand side of the equation. They increase on the right or credit side. Stockholders' equity overall increases on the credit side. Okay, so that's a basic equation. Again, the two accounts that increase equity are common stock and revenue. So those both increase on the credit side as well. And then on the left, we have dividends and expenses. And those both increase on the left with a debit. Now you probably notice that we abbreviate debit and credit. Credit makes sense, CR. DR is how they abbreviate debit, I guess, to match credit. It makes no sense, right?
No, I thought they would use DB.
Right, it makes more sense. I think they were just like, oh, we should match it to credit. There's no R in debit, but whatever. So DR stands for debit, CR stands for credit. That was not a typo. That is the legitimate abbreviation.
Oh.
It always makes me sit and wonder, who decided that? But it's neither here nor there. That's what we use. Okay. So T account is kind of what I've written up here, for the main account. So T account is just a way of keeping track of an account, like its increases and decreases. Like think of cash. As we go through the month, we're receiving cash and we're spending cash, right? So cash is going to be increasing and decreasing throughout the month. So a T account is just an unofficial way to keep track and to kind of visualize what's happening in each account. We're going to use a ledger to keep official track of those changes, kind of like if you ever kept like a checkbook ledger. Most of us don't, right? But if you log onto your bank account and see the increases and decreases, it's like that, okay? And you keep a running balance. It's the same idea. But T accounts, I always encourage students in accounting to use T accounts. I use them in my upper level accounts or classes too, because it's just easy to see and visualize what's going on. I had a student, I was laughing, I told her I was going to use her as an example. In my managerial accounting class that I've had for college accounting, financial, and now managerial. And she was working on the homework and managerial, and we were working in there, and she goes, so I started using my T accounts, and it really makes sense. You were right. And I'm like, thank you. It took her 3 semesters. But and I'm like, can I use you as an example to encourage them to use T accounts? And she's like, absolutely. I wish I would have started using them sooner. And I'm like, I wish I would have recorded that. But it's true. It really does help. So get into the habit of bringing scrap paper and writing T accounts. It really will help. And you'll understand as we move through. So all we're doing with the T account is we list the account title like cash. And then we show increases in assets as a debit or the left side and decreases as a credit. Okay. So an example of what a T account might look like when we have like 6 transactions is this. So on our left-hand side, on our debit side for our T account for cash are increases. So we received $25,000. We received $7,500. On the credit side, those are all decreases, money we've paid throughout the month. At the end of the month, we want to know how much cash we have, right? Kind of important. So we add up our total debits, then we add up our credits, and we subtract. Total money coming in minus total money coming out. We have $5,900 left. And since that's money left, that's an increase in cash, right? It's a positive balance. That's listed on the left, okay? So the balance side is always like the normal increasing side. So I call this my normal increase side or my normal balance side. So again, like these transactions are ones we actually analyzed, and we'll do some again today probably in last chapter, where we already said, oh, cash is increasing. So now we're really only going one step further. When we say cash is increasing, now we're going to say, well, we debited cash because it's increasing. Okay. So again, I kind of already said this, but we add up, both sides and subtract to get a balance. So the normal balance of an account is the side that it increases on. So for example, all assets have a normal debit balance. All liabilities have a normal credit balance. Okay. All expenses and dividends have a normal debit balance. All common stock and revenue have a normal credit balance. So the normal balance is just the increasing side. This I've given you, we've went over. It's on the board, so we'll go through it. Let's see, yeah, we'll go over this first. So the whole purpose of this is so we can now officially record transactions. So using the rules of debit and credits, we record transactions in what we call a journal. Now, in today's world, that's all computerized. So like, for example, I work in QuickBooks. So I go into QuickBooks, I open up my journal, and I can start journalizing transactions. I have receipts, or I have, payment stubs, bank deposits. I have all these source documents, things that tell me what's going on in my business. I take those and I put that into my journal. There's a lot of steps, but it's really not that hard. So we're going to look at a journal here in a minute. So the first step is we put the date of the transaction. Then what we do is we list the account that is debited. Okay. A debit can be an increase or decrease depending on the account. We list the debit account, and then we list the amount in the debit column. Then we list the credit account, and we put that amount in the credit column. Step 4, we will not do in this class. It won't have you do in Cengage, but normally we put a description of what happened, like bought supplies on account, but we won't have to do that. And step 5 we'll get to here in a little bit. So the process of recording transactions in the journal is called journalizing. Okay? And these entries are called journal entries. So to visualize it, because I know that makes it easier, we had a transaction on November 1st. Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in exchange for common stock. Again, this was a transaction we dealt with last chapter. And we said cash was increasing and common stock was increasing. Well, now all we're doing is going a step further. Cash is an asset, it was increasing. So cash is our debit account. Common stock is increasing, so it's my credit account. Okay, so I'm just going one step further. So when I do that, to follow my journal, it always says journal, and then we're on page 1 here. These are always like the column headers. We put the date, November 1st, the year above it. We only have to list that year and really even the month unless it changes or unless we change pages. Okay. Then we list our debit account first. The debits are always listed first. We have cash. And we put that in the debit column, 25,000. Common stock's our credit account. Notice we indent just a little bit. That just helps us show that it's a credit. And then that 25,000 goes as a credit. Here it's showing you in your accounting equation in a T account what that looks like. Assets increased, debit 25,000. Equity increased, credit of 25,000. So we're following our rules of debit and credits. We have at least 2 accounts are being affected. We have at least 1 debit, at least 1 credit. Our accounting equation is in balance. Our debit was listed before our credit. Okay, so those are all kind of the important things when we're dealing with transactions. And y'all are already doing well in chapter 1 on remembering to list both sides. So I think you guys got that down. So now you're just, again, putting it into like a formal account listing. So we're journalizing now. So again, it's really, if anything, it might be a little bit easier than that really long table we did in chapter 1, where you have to scroll and like balance it and all of that. That's really a pain. I know it's a pain. But you've already done the hard work. You've already identified the accounts and you've already said whether they're increasing or decreasing. Now you're just going, well, if it's an increasing asset, then that's a debit. Okay. Does that make sense? Okay. So now they're just showing us some more transactions. And once we go through a few of these, we'll practice them together in the chapter 2 practice. November 5th, Net Solutions paid $20,000 for the purchase of land. So we purchased land. Well, what type of account is land? Asset, good. Is it increasing or decreasing?
Increasing.
Increasing. So if land is an asset and it's increasing, I know it's my debit account. Well, what about cash? We know we paid cash. Is it increasing or decreasing?
Decreasing.
Decreasing. So cash is credited. So here we're all on the left-hand side, right? We're only dealing with assets. One asset increased and got debited. One asset decreased and got credited. Okay. So there we are on our little T accounts. So land was our debit. It's listed first. Cash is our credit, listed second. Okay. And then we just keep going. On November 10th, Net Solutions purchased supplies on account. Well, supplies is an asset, and it's increasing, so it's debited. Accounts payable is a liability, and we owe, and that what we owe is increasing, so it is credited. $13.50. On November 18th, Net Solutions received cash of $7,500 from customers for services provided. So we provided services, they paid us cash. So we received cash. Cash is an asset. It's increasing, debit. When we provided services, that's revenue. Revenue, the revenue account fees earned is increasing, so we show that with a credit. If we had billed them for services instead of cash, what would I debit?
Accounts payable.
The other one.
Accounts receivable.
Accounts receivable. Those are easy to get mixed up. Yeah. Accounts receivable. So always think when it's accounts receivable, I'm the business, it's money receivable to me.
Okay.
Yeah. If it's a payable, that's something I owe or I have to pay.
Okay.
Those are easy to get mixed up. Here, this one looks a little different, doesn't it? Notice we have 4 debits and 1 credit. So that's completely okay. This is what we call a compound transaction or a compound journal entry. So we paid several bills. We received a bunch of bills and we paid them all at once. We paid wages, rent, utilities, and some type of miscellaneous expense. So we can do that. We can put it all as one journal entry. You can also separate these out. You know, it doesn't, in the homework, it'll want you to put them in a compound entry though. But in theory, in the real practice, it would be okay to enter each one separately. It's just a little more work. So in this case, when we paid 4 different expenses with cash, all 4 of our expense accounts are increasing. So we debit those. Which overall, that's decreasing equity, okay, with that debit. And then we add them all up and credit cash to pay the full amount of $36.50. So here we have 4 debits and 1 credit. Again, the big thing to look at is all of our debits are listed first and then our credit. Okay? So we list all of our debit accounts and then our credit. Okay, let's see. On November 30th, we paid creditors on account. So this is when we pay towards what we already owe. Yeah, it gets a little tricky. This one trips students up sometimes. All it's saying is we're paying on a debt we already owed. We're paying our creditors. So when we do that, well, cash, we're paying money, so cash is credited, it's decreasing. And accounts payable is decreasing because we're decreasing what we owe. Think of it like paying your credit card bill. It had a credit balance, I paid towards it, so it's going down, I'm decreasing it. So accounts payable is debited and cash is credited. Okay. I think we're getting close to the end here. This is our other tricky one. Net Solutions purchased $13.50 of supplies on November 10th. We already journalized that. We increased our asset supplies. Chris Clark determined that the cost of supplies on hand as of November 30th was $550. So he went and counted the supply closet, and we have $550, left in supplies. So what we do is we took $13.50, all the supplies we had, minus what's still there to get what was used up. So in this case, we have to calculate what was used up. So $800 of supplies must have been used up during November. Well, again, when supplies get used up, they're no longer an asset to us because they're no longer there. We need to expense them out. So supplies expense gets debited and increased to the supplies expense account, and supplies gets credited. So what they're not really showing here is we started with a $13.50 debit, we have an $800 credit. Supplies ending balance would be the $550 that's actually in supplies. Okay. It did. It went down because those were supplies that were used up. And I think this one, it might be the last one here. On November 30th, dividends of $2,000 were paid. Well, dividends decreases equity, so we show a dividend increase as a debit, and paid with cash, so cash gets credited. And they're showing it again in the T accounts. Okay, I thought that's where it ended. So that goes through like an example of pretty much every account type. So what I want to do now is switch over to the Chapter 2 practice. And we'll work on a month's worth of transactions in that to see, how we're analyzing and everything. So in Canvas, go ahead and log into Canvas and open up that Chapter 2 practice. Chapter 2 practice, the very first one is dealing with transactions and kind of putting them into journal form. So it says Zenith Consulting has the following accounts. So this is our chart of accounts, just not with the numbers and everything, but a full official listing. So we have the assets cash, accounts receivable, supplies, and office equipment. We have one liability, accounts payable. Common stock, retained earnings we're not going to use right now. Dividends, we have one revenue account, fees earned. And then we have expenses, rent expense, advertising, utilities, and miscellaneous. So those are the accounts we're going to use, and we're going to determine the debits and credits for each one of these transactions. Okay. So we're going to step through them. So on March 1st, we paid rent for the month of $4,000. What two accounts are being affected if I paid rent?
Cash and rent expense.
Very good. Cash and rent expense. Is cash increasing or decreasing?
Decreasing.
Decreasing because we're paying money. Good. So would I debit or credit cash?
Debit.
Credit.
Credit.
Credit, yeah. So if cash is decreasing and it's an asset, we're going to credit cash. So then rent expense, is it increasing or decreasing?
Increasing.
Increasing. So we know we're going to show that with the debit. So when we pay an expense, rent expense is increasing, so it gets debited. Cash is decreasing, so it gets credited. So when I come down here, I always list my debit first. So I'm going to put rent expense and cash, 4,000.
So you always put the debt in your debit first?
Yes, yeah. And I'll remind you that I will say that a lot probably because when we start working on the project and you're given the blank journal and I'll come over and you'll be like, why is it wrong? Well,
Always first debit.
yeah, debit always is listed first. So our debit first and then our credit. Those are like the two biggest errors I see in journalizing, is listing them in the wrong order. And then the other big one I see is just listing one side when you're given a blank journal. This is pretty easy, like it prompts you, right?
Mm-hmm.
So when you have a blank journal sheet, which you will on your homework and then on the project, for some reason that's when students like start just putting one account. That's why you're probably like, why does she keep saying that? Well, yeah, seen it a time or two, been around the block, the accounting block for a while. Seen it all. Probably not, right? Every semester I'm like, that's a new one. Keeps it fresh.
Keeps you on your toes.
It does. On March 3rd, we paid advertising expense, $13.50. What two accounts are being affected there?
Advertising expense and cash.
Very good. Our expense, advertising expense, and cash. It's really just like the first one, isn't it? We paid an expense. Anytime you see the word paid, we know cash is credited. Cash is decreasing when we see the word paid. So that's kind of a little trigger word there for you. Paid, cash credit. Okay. So on March 3rd, we'll have a debit to advertising expense and a credit to cash again because we paid, bless you, $1,350 for advertising. And also another little tip or trick, expenses, as you can see as we journalize, they're always increasing, they're always debiting. Okay. You can't really decrease an expense, like it's an expense incurred. So for now, like until we close accounts in like another chapter, every time you have an expense, it's always a debit. Okay? So expenses are always debited at this point. So when we pay those expenses, it's always a credit to cash. Okay, March 5th, we paid cash for supplies. What two accounts?
Supplies and cash.
Supplies and cash, good. Which one do I debit?
Cash.
Do
No, supplies.
For supplies?
Yeah.
I thought since supplies are also considered an asset, I don't know.
It gets confusing, right? Yeah, they're trying to trip you up. So we purchase supplies. Supplies is an asset. Are supplies increasing or decreasing? Increasing. So the asset supplies will be debited because the supplies are increasing. We're dealing with two assets though, right?
Mm-hmm.
So we have supplies, asset increasing. But we paid for those. So cash is going down, cash is decreasing. Okay, so we'll credit cash. 1,800. Okay. So there we have two assets. One's increasing, one's decreasing. Okay, March 6th, we purchased office equipment on account. What two accounts are being affected there?
Office equipment expense or accounts payable?
Just office equipment,
Just
but yes,
like
yeah,
that.
office equipment and
Oh.
accounts payable. Good, very good. Well, what type of account is office equipment?
A asset.
An asset, good. Is it increasing or decreasing? Increasing. So if we have the asset office equipment increasing, debit or credit?
Debit.
Debit, good. So when we purchase office equipment, just like we purchase supplies, we're going to debit that asset account, office equipment.
Oh, I did have it right. Okay, the first time.
And then you switched it.
Yes.
Second guessed yourself.
Yes.
Don't do that. And then yes, accounts payable, because we bought it on account. Whenever you hear or see the term on account, if we bought something on account, we didn't pay today. So we bought it on credit. So that's accounts payable, which is a liability, which increases on the credit side.
Right.
So we debit office equipment and credit accounts payable. Any questions so far? Okay. March 10th. We received cash from customers on account. What does that mean? Receive cash from customers on account.
They paid us for services
That rendered.
Are they paying?
later, after the fact.
They're paying after the fact. Good. So if they're paying after the fact, that means the services have already been performed, right?
Yeah.
So that's kind of your clue here. When they say that we received cash, the received cash part's easy, right? We got paid.
Yeah.
So what's cash doing? Increasing or decreasing? Increasing. Okay.
Would it be cash or fees earned?
It's going to be cash that we received. And then it says from customers on account. Well, when it says from customers on account, that means we've already billed them previously.
Accounts receivable.
Accounts receivable.
Yes.
Yes.
Good.
Okay. So receive cash from customers on account. So what that's telling us is we already performed the services maybe last month and we billed them. When we billed them, we recognize that revenue.
Right.
When we billed them.
Yeah.
We debited accounts receivable and credited fees earned. So when they're paying us what they owe, we're receiving cash. So we're debiting cash and we're crediting accounts receivable because what they owe us is actually going down. Okay. Very good. That one's a little tricky because we didn't see that happen, right? Like when you're keeping books in real world, you know, you see, oh, they owe us and now they're paying us. So it makes, you know, it's like the whole picture there. So sometimes we have to recreate what happened before that. You didn't think you'd be recreating things, right? On March 15th, we paid a creditor on account $31.80. Okay. What two accounts are being affected there?
Accounts payable and cash.
Perfect. Accounts payable and cash. What's happening to accounts payable?
Increasing. Debit.
It is debited.
So, yeah. So it's the first one listed, right?
Yes.
Okay. But it's,
Yeah.
yeah. Well, no, it's decreasing because of the way that, because it's a liability.
There you go. Yes.
Okay.
Yes, it is debited. Accounts payable is going down. So when we bought office equipment on account here, we credited accounts payable $11,500. All we're doing now is paying part of that bill, not the whole thing, clearly. We're paying $31.80 of that, like roughly a third of it, right? So we're reducing what we owe. So we are paying towards this accounts payable liability. It was a credit, so we debit it to reduce what we owe. So accounts payable is debited $31.80. And what do I credit?
Cash.
Cash. Perfect. So, you know, again, sometimes it helps just to draw out the little T accounts and see what's happening. I'm a very visual learner. And so to me, it makes more sense sometimes just to see, well, what's going on? Well, we knew, let's see. On March 6th, we bought office equipment on account. And so we had credited accounts payable here. So that's what our accounts payable looked like. And then on the 15th, we made a payment. So we decreased that by $31.80. So then we could subtract to get a current balance. Okay. Should be like what, like 8,320? Yeah, I can do it in my head, right? It's always a good day when I can do math in my head.
That's still what we owe them.
Yes. Yep.
Okay, okay.
Yeah, that is a credit balance, so that is the remainder of what we owe them.
Okay.
So then like next month, maybe we pay another $31.80 and it goes down again.
Okay.
Yep. So again, sometimes it helps when you're working on these to write all the T accounts out. And kind of visualize, well, what's going on here? What's happening in accounts payable? Okay. It takes a little more time, but it will help make it all click. Back in the day when I learned accounting, we didn't have computers, so get to date myself, right? We had I should take that back. We had computers. No, not that old. We had.
No, I am. That's the one we had. Remember that little bitty screen?
I do, like the Apple.
Yeah, that's what I started with.
That is the one I started with. When I was in high school and even in college and doing accounting, we had desktop computers, but we had to do accounting by hand. I should clarify that, right? I am old, but I'm not that old.
I know.
Depends on the day.
I really show my age. Yeah.
I show it daily.
Well,
You
mine
know?
was the, if you remember.
Yes,
with
I
the
do,
little
and
bitty
we had
screen,
them in
that's the one I
elementary.
started with,
I
yeah.
remember having
Yep.
the Apple computer that we got to play on like once a month or something.
You're like, what? You can't, yeah. It was difficult to see.
They've come a long way. Now we have computers in our hands.
Yeah,
You know?
it's like green writing and everything on
Yeah,
it. Yeah,
I remember those.
It was not fun.
And we were so excited, though, that we got to be on it. Anyway, it's come a long ways, right? Oh,
Everything color now.
I know, right? It's not all in DOS. That's another fun story I always say. When I programmed in college, I learned to program in DOS, and people are like, what? See, that makes me feel old.
Sorry.
It's okay.
You color and dots?
My color and dots.
You didn't do that?
Not the process.
So DOS was the original like operating system instead of Windows, and we had Windows. Don't get me wrong, we had Windows operating system in college. But when I was a freshman, I was in computer science. Our first programs that we wrote was in the DOS operating system, which is literally a black screen with a blinking cursor and white text. And so you had to type in like all of your code and then run it and hope that it worked.
It's basically command prompt in Windows.
Yes.
Like if you ever open up CMD prompt in Windows, that's all it was.
Yeah.
Like you can actually still get DOS on
You
computer.
can.
It's just a joke, but
It is.
it's funny because you can switch. I swapped my mom's computer to DOS one time and turned it on. She's like,
It's a fun trick, right?
no. I don't even know how to do it.
Yeah, it's been a long time since I've played in DOS. But yeah, we had Windows, but we didn't have Windows-based programming yet that freshman year. We did by like sophomore or junior year, but yeah. So then you had to write, you probably don't even know that we had these old, what they call dot matrix printers. So y'all are learning something very exciting here. It's a dot matrix printer, and it was paper that had the little lines on either side that were perforated holes. And so I would print my program that I had spent, hours writing, and it would print like, like really old and loud. And it'd be all one big continuous paper. And then it'd be like error on line 75. So you'd have to find, the lines were numbered. So you'd have to go to line 75 and find out what your error was and go back in and fix it. Yeah.
Fun.
It was not fun. So doing accounting on paper by hand didn't seem that tedious at the time. Anyway, we used a lot of T accounts. So while I love doing computerized accounting and I do QuickBooks and everything, I do think sometimes just writing it down still does make a difference in how you process it. So I try to encourage you to do both. We use the computerized, which is what you'll see in the real world. But sometimes just to see it, we'll write it on the board or we'll write it down. But that's my tangent for the day. Things I tell my kids, that they're like, oh my gosh, you're so old, this kind of stuff. Okay. The 27th, we paid cash for miscellaneous expenses. What two accounts are being affected there?
Miscellaneous expenses and cash.
Very good. Yeah, miscellaneous expenses, which is it increasing or decreasing?
Utility. Yeah, the
Decreasing.
miscellaneous is a debit.
Increasing.
Oh.
Yeah. Expenses will always show as an increase.
Increase. Okay.
So miscellaneous expense will be debited.
That is first. I didn't do that right. Okay.
And cash, since we paid it, is credited. Cash is paid out the door, decreasing, debited, or credited, sorry, credited. March 30th is really the same kind of idea. We paid the telephone bill for the month. So what account am I debiting there?
Utilities and cash is being credited.
Very good. I paid my utility bill or my telephone bill. So utilities expense is debited and cash is credited. And that was for what, 550? When I'm scrolling, I sometimes forget the amounts. Okay, we'll finish this up and then we'll be done for the day. So 3 more. All on the 31st. 31st, fees earned and billed to customers, 37,200. What two accounts?
Receivable, credited, or debited, and fees earned credited.
Very good. Fees earned and billed to customers. So in other words, we invoiced customers for services performed. Okay. So we perform services, we billed our customers. So they owe us money. When customers owe us money, that's accounts receivable, which is an asset. So our asset, accounts receivable, is increasing. 37,200. And then, as you said, fees earned, we earned revenue, right? We perform services and we billed them for them.
Mm-hmm.
So fees earned is credited, our revenue account, fees earned. Everyone got that one? All right.
I moved ahead when I got it all done.
Hey, that's okay. Paid electricity bill for the month. Well, we've done a lot like this, right? So what's the debit account?
Utilities payable.
Not payable. That one, they
Expense?
threw that in there to, yeah, expense.
Okay.
They threw that in there to throw you off.
Okay.
When we're paying it, when we receive the bill and we're paying it today, it's just an expense. So utilities expense of $830, and we credited cash, $830. So yeah, sometimes they throw in those extra accounts there.
Yeah, that got me on that one.
It would be a payable if we received the bill and we weren't paying it today.
Okay.
That's why they try to confuse you. And then last but not least, we have paid dividends of $2,000.
Dividends expense?
Just the dividends. Yeah.
Okay.
Yeah. So it's actually just the account dividends gets debited because we're increasing our dividends. That's when they threw at you too.
Uh-huh.
And then what do I credit?
All the stuff. Yeah.
Cash.
Cash. Yeah. I paid dividends. And remember, dividends are just shares of profit that we're sharing with our
All the
stockholders.
stuff. Yeah.
So we decided we had a profitable year. We want to share some of that profit with our shareholders or stockholders. So we pay them out dividends. So dividends decrease equity with a debit to dividends, and then cash is decreasing with the credit. Any questions on any of what we've covered today? Okay, so just kind of, be reviewing since it's Wednesday. Obviously, we have a few days before our next class. So just, you can open up the chapter 2 homework and start working on some of these where you're journalizing and everything and kind of just practice a little bit. That's what I encourage students, even if you're just looking at this every day or every other day for a few minutes and kind of working on understanding it. Monday, we'll pick back up. We have a little more of the chapter just to talk about journalizing and posting to the ledgers and doing trial balance. So we'll wrap up chapter 2 and we'll finish up this practice. Okay. Have a wonderful weekend. Hopefully the weather will be nice. Happy Valentine's Day since that's Friday.
Valentine's Day to you too.
Thank you.
Other than that,
A nap sounds great. Unfortunately, I have a 5:40 class.
My English teacher, my professor made it very well will be no Valentine's plans this weekend.
Oh, that stinks.
Like 4
Bye.
assignments due by Sunday
Ew.
by
Ew.
11:55.
Anti-love, right? Bye.
Yeah.
Yeah,
I'm
that's
like,
brutal.
I don't have no Valentine's this year.